Let me ask you a question. Be honest. Are you absolutely sure you're not leaving money on the table for the tax man? Because, get this, recent figures show that over 40% of small businesses in the UK are missing out on tax savings. That's a staggering amount of hard-earned cash just gone, usually because people just don't know what they're entitled to claim.
Well, that's exactly what we're going to fix today. Welcome! In this guide, brought to you by the team at My Tax Accountant, we're going to walk you through the essential tax planning strategies for your small business for the 2025/26 tax year. Think of us as your guide to getting tax savvy.
We're going to keep it super simple. First, we'll get the foundation sorted. The stuff you absolutely have to know. Then, we'll hunt for some quick wins, easy things you can do right now to save money. And finally, we'll dive into the real game-changing strategies that can make a huge difference to your bottom line.
Right then, let's start at the beginning. It's kind of hard to save money on tax if you don't know what you're actually supposed to be paying, right? So let's break down the core tax obligations for your small business.
First up is the big one for limited companies, corporation tax. Simply put, it's a tax on your profits. For the 2025-26 tax year, the deal is this. If your profits are under 50 grand, you pay 19%. If you're making over $250,000, that jumps to 25%. And for profits in between, there's a sliding scale. This is exactly why knowing and managing your profit figures is so important.
Next on the list is VAT, or value-added tax. This is the tax that's tacked on to most goods and services. Now, the magic number you need to remember here is £85,000. Once your annual turnover hits that mark, you have to register for VAT. It's not optional. But here's a thought. Some businesses actually choose to register before they hit the threshold. Why would they do that? Well, it means you can claim back the VAT on things you buy for the business.
And finally, we have national insurance contributions, or NICs. You've probably seen these on your payslip. They're payments that pretty much everyone makes to qualify for things like the state pension down the line. So just to recap, corporation tax, VAT, and national insurance. These are the three pillars of your tax world. Nailing these is step one.
Okay, with that groundwork in place, let's get to the fun part, finding some quick and easy wins. These are the everyday savings that, honestly, so many businesses just completely miss.
The absolute #1 way to cut your tax bill is to claim for every single thing you're allowed to. Seriously, every pound you claim as an expense is a pound you're not paying tax on. We're talking office supplies, travel, your accountant's fees, staff costs, rent, the list goes on. Let's imagine Alex, a web developer working from his flat in London. He buys a new laptop for £1,500. That's a business expense. He can knock that full amount off his profit, which means a smaller tax bill. Simple as that.
Now, what about those bigger ticket items? Things like machinery, vans, or serious bits of kit? Well, there's a brilliant thing called the Annual Investment Allowance, or AIA. It lets you deduct the full cost of qualifying assets in the year you buy them, up to a massive limit of £1 million. So if your company buys a new machine for 50 grand, you can write off that entire cost against your profit right away. It's a huge incentive from the government to get businesses spending.
Okay, here's a pro tip for you, and this one is pure gold. Did you know that when you register for VAT, you can actually look backwards? HMRC lets you reclaim VAT on goods you bought for the business up to 4 years before you registered, and on services up to 6 months before. That could be thousands of pounds back in your pocket from old stock, tools, or consultancy fees. It's an amazing opportunity.
Right, we've banked those quick wins. Now it's time to get into the stuff that can be a real game changer for your business. And it all starts with how your business is legally set up.
For most people starting out, the choice comes down to two main paths: operating as a sole trader or setting up a limited company. As a sole trader, it's simple. You and the business are legally the same thing. The profits are your income. The big catch, if the business gets into debt, you're personally on the hook. A limited company, though, is its own separate legal person. This creates a firewall protecting your personal assets, which is a massive plus. And its profits are hit with corporation tax, which can often be lower than personal income tax.
And that legal separation is the key that unlocks one of the most powerful tax strategies out there. I'm not kidding. Stay with me for this next part, because getting your head around this could be the most profitable 5 minutes you spend this entire year.
It all comes down to the classic and super effective strategy of paying yourself using a mix of a small salary and then dividends. This is where being a limited company really comes into its own.
So, how does it work? It's a really simple two-step process. First, you pay yourself a small salary from the company. The magic number for this tax year is £12,570. Why that much? Because it's just enough to qualify for your state pension contributions, but it's low enough that you pay zero income tax and zero national insurance on it. Plus, it's an expense for the company, so it lowers the corporation tax bill. Then, for step 2, you take out any other profit you want as dividends. The beauty of dividends is they don't have national insurance, and their tax rates are much kinder than salary tax rates.
And this chart shows you the result in black and white. If we take that £50,000 profit, look at the difference. With the salary and dividend mix, the vast majority is your take-home pay. The slices for tax are tiny. If you took it all as salary, those tax slices would be way, way bigger thanks to income tax and NI. It just shows you how powerful this one little structural decision can be.
Okay, you've got the basics down, you're using the game changers. Are you ready to level up? Let's talk about some more advanced long-term strategies to protect your wealth and your business's future. First up, pensions. Paying into a pension directly from your limited company is one of the smartest, most tax-efficient moves you can make. Why? Because the company's payment is a business expense, so it cuts your corporation tax bill. The money goes straight into your pension pot without you or the company paying national insurance on it, and it grows tax-free. You can put in up to $60,000 a year. It's a total win-win, saving tax now while building a nest egg for later.
Next, R&D tax credits. And don't switch off thinking this is just for scientists in lab coats. This amazing government scheme rewards any business that's trying to innovate. If you're developing new products, new software, or even just better ways of doing things, you could be eligible. This can slash your corporation tax bill, or you might even get a cash payment back from HMRC. It's a must investigate for any forward-thinking business.
And finally, let's talk about the end game, selling your business. When that day comes, you'll face capital gains tax on your profit. But with something called Business Asset Disposal Relief, you can slash that bill. It lets you pay a tax rate of just 10% on your gains, up to a lifetime limit of £1 million. This isn't something you think about on the day you sell. You need to plan for it from the start to make sure you get the maximum reward for all your hard work. Phew! We have covered a huge amount of ground, from the absolute basics right up to your eventual exit strategy. The main thing to take away is that smart tax planning isn't something you do once a year. It's an ongoing process. Your next job is to build these ideas into a proper plan that works for you. So, let's quickly boil it all down. 1. Claim everything. Be religious about your expenses. 2. Get your business structure right. For many, a limited company is the way to go. 3. Use that super efficient salary and dividend mix. 4. Always be thinking long-term about pensions and exit plans. And 5, and this might be the most crucial point of all, don't try to do it all yourself.
And that's where getting professional help is just invaluable. A great accountant is more than a bookkeeper. They're a strategic partner who can build a plan that's perfect for your specific business. If you're ready to create a personalized tax plan and stop leaving money on the table, the team at My Tax Accountant would love to help. You can get in touch with them directly on WhatsApp or by phone at 07854 255 375, or just send an email to info@mytaxaccountant.co.uk. I really hope this has helped you feel more confident about tackling your business taxes.
And for more expert tips just like these, make sure you hit that subscribe button. Thanks for joining us.